For 25 years, individual savings accounts, otherwise known as ISAs, have been a great way to invest and grow your wealth. Up until the recent budget, they were virtually free of all taxes. Now, whilst the budget has changed the rules on inheritance tax, by proposing that from 2026, shares in AIM stocks will receive reduced business relief, dividends and interest received in an ISA is still free from income tax, and gains are still free from capital gains tax. The only downside of an ISA is its fairly low annual allowance. Now, you can only invest or add up to £20,000 a year into an adult ISA. And this can be a problem for those with larger sums to invest, who want to make it as tax efficient as possible, but have yet to put much in ISAs, and are not keen on pensions following more changes in the recent budget. It can take years to build up a large investment in ISAs, and if you don't have the money now, you're missing out on using ISA allowances, as these do not carry forward like they do for pensions. In this video, we'll discuss a great little hack you can use to ensure you don't miss out on using your ISA allowance, even if you don't have the money now. Hi, my name's Carl. If you're new here, welcome to the channel. I'm a practicing regulated financial advisor and also help run a fund management company. Now, it's important to note that these videos are not meant to provide advice. These are not through my hat as a regulated financial advisor. They are my personal thoughts and guidance to you. With these videos, you need to go and do all your own research and guidance on top of this. Now, usually I'll cover personal finance subjects, such as investments, pensions, taxation, and legacy planning. And I'll also go off track a little bit and look at some interesting investment angles like Bitcoin and gold that other advisors won't normally talk about. Now, you may be thinking, what's the point in building up your ISA allowance if you don't actually have the money to invest? Well, you might not have the money to invest now, but you might someday soon. This could be for a variety of reasons, some of which we're going to highlight. Okay, firstly, what about a future inheritance? Is it likely that you will soon receive an inheritance, either through the death of someone close to you, or by them wanting to make a gift to you during their lifetime to help them avoid inheritance tax? Okay, another option, what about an insurance payout? If you've been in an accident or suffered a critical illness, you may be due an insurance payout. You might even be the beneficiary of someone else's insurance payout on their death, and you may well need to invest this money to live off, especially if you lose a partner. Okay, another option is downsizing. If you are selling a property, move into a smaller house and releasing equity, you may want to invest this equity to ensure its purchasing power is protected and or provide you with an additional income in retirement. Again, another option, what about selling or winding up a business? Now, you might receive a lucrative offer for your business, or it may be time for retirement and you have a lot of cash still held in your business account. What about withdrawing the tax-free lump sum from your pension? In retirement, you may wish to take out your 25% pension tax-free lump sum, especially from age 75, following the proposed changes announced in the recent budget. Now, this could potentially avoid large taxes on the amount if you died post age 75. In all of these scenarios, you could be talking about a pretty big amounts, and therefore trying to squeeze this all into 1 year's worth of ISA allowance at £20,000 is just not going to cut it. If you don't have a build-up of ISA allowance available, the majority of the amount you receive is going to be invested and then subject to taxes. Income tax, capital gains tax, and inheritance tax rates on money outside a pension or ISA are pretty dire. And ultimately, this is going to reduce the level of income you can earn from the payout. The key to increasing your ISA allowance without having to invest all the cash right now is to use a flexible ISA. Flexible ISAs were introduced in 2016 and essentially allow you to take money out of an ISA and then put it back in without it impacting that year's allowance, providing you do it in the same tax year. So for example, if you had already built up £10,000 in an ISA during the last tax year, in the current tax year you can now take out the £10,000. And before the end of the current tax year, you would be able to put 30,000 back in, which is the 10,000 you had previously taken out, and 20,000, which is the new current year's ISA allowance. The key point to remember here is that you only need to hold all the money inside an ISA on the 5th of April to ensure that that year's allowance and any previous year's allowances are protected. You can then take it all out from the 6th of April and not put it back in until the next 5th of April. Again, as an example, and assuming the annual ISA allowance stays at £20,000, you could input £20,000 into an ISA by the 5th of April 2025, take out £20,000 from the ISA on the 6th of April 2025, input £40,000 into the ISA on the 5th of April 2026, take out £40,000 from the ISA on the 6th of April 2026, input £60,000 into the ISA on the 5th of April 2027, take out £60,000 from the ISA on the 6th of April 2027. And by the time you get to the 6th of April 2027, you have essentially built up an ISA allowance of £80,000 whilst only having the money sat in an ISA for around 6 days. If you're a couple, then you could of course double these amounts. Now, I know what you might be thinking. You still need the actual cash to deposit into the ISA to make these numbers work. And yes, you are right. However, here are just some of the ways you could make it work using other money not originally allocated for investing. Okay, firstly, we've got using money you have previously lent to your limited company. So if you have your own limited company, then at some point you may have lent the company money in the form of a director's loan. This is usually a tax efficient way to provide the company with capital and receive an income from the company. So if you have money sat inside the company that is not needed for a while, then you could repay yourself some of the loan. Place it inside your flexible ISA for 2 days as per the example we've shared earlier, and then take it out and lend it back to your company. Then repeat this in future years. Okay, another option, using dividends from your limited company. Most limited company owners will take their income from their company in the form of dividends. To save accounting costs and admin paperwork, you may choose to take your dividends as lump sums once or twice a year. If you then use that dividend to live off, you might park it in a bank account and draw from it when needed. Before parking this dividend payment in cash, you could place it into your flexible ISA first, making sure you use your current year's allowance. Then take it back out for spending. You just need to make sure an amount equivalent to your built-up ISA allowances is sat in the flexible ISA on the 5th of April each year. Okay, option 3, cash savings allocated for spending or a rainy day. Similar to how you would use the dividends in the example just spoken about, if you are prudent and keep an element of your wealth in easy access cash accounts to cover, say, 6 months to 2 years worth of normal spending, again, you could use some or all of this money to temporarily place into a flexible ISA to build up your allowances. Number 4, allocate money to ISA first and then pensions. So if you make regular or one-off personal contributions to your pensions each year, then you could consider placing the cash in a flexible ISA first. Then, once the money has been in the ISA on the 5th of April, you could then use it to contribute to your pension. Now, this only works if you have already built up at least 1 year's ISA allowance with other money, otherwise you would lose the pension tax relief in the current tax year. For example, in tax year 1, you contribute £20,000 from your salary into a flexible ISA. In year 2, you take out the £20,000 from the ISA and contribute it to a pension. This grosses up to £25,000 inside the pension. Before the end of year 2, you contribute £40,000 into your ISA. In year 3, you take out the £40,000 from your ISA and contribute it to a pension. This grosses up to £50,000 inside the pension. Before the end of year 3, you contribute £60,000 into your ISA. Now in year 4, you take out £48,000 from the ISA and contribute it to a pension. This grosses up to £60,000 inside the pension and is the maximum under the pension annual allowance rules. Now, you still have £12,000 left in your ISA at this point and need to contribute £68,000 into your ISA by the end of the tax year. By year 5, you can take out £48,000 again from your ISA and pay it into your pension, which grosses up to £60,000. Now, by this point, you have a £32,000 flexible ISA, but you have built up a total allowance of £100,000. You have also input £195,000 in gross pension contributions. Overall, cash of £188,000 has bought you £190,000 pension contributions and £80,000 in ISA allowance. Now, clearly, you need to have the cash or salary to make this work, but the same concept applies even if you're using smaller numbers. Whilst the flexible ISA is a great product, they are not that easy to come by. Most stockbroker accounts like Hargreaves Lansdown, AJ Bell, Interactive Investor, etc. at the time of filming do not offer one for their stocks and shares ISA. This is probably not a bad thing, as you don't really want to be investing your flexible ISA money in the short term if you are only using it to build up your allowance for the future and will shortly take it back out again. Luckily, again at the time of filming, there are quite a few high street banks that do offer a flexible ISA, including the likes of Barclays, Lloyds, Nationwide and Halifax. It's probably a good place to start with the bank you do your normal day-to-day banking with, as this will be the quick and easy to set up. Remember, we are not after the best interest rate here, as for the majority of the time the money is going to be pulled out of the ISA. Be careful though not to hold more than £85,000 with one banking institution though, as this is the deposit protection limit. If you feel you are over this amount with one bank, you may need to open a new flexible ISA with a different bank in the next tax year. A final key point is that if at any point you don't fill your flexible ISA with the cash needed to protect your built-up ISA allowance, then you will lose the previous year's allowances and you'll be back to starting with a £20,000 allowance. Now, this ISA hack is a tactic that helps you to secure a win in the tax game. This government, and most likely successive governments, are going to need more and more of your wealth to fund their spending. Every little tactic helps when it comes to defending against excessive taxation. Now, I hope you found this video useful. If you have found some value from it, please leave a comment and ask any questions, and I'll try and get back to as many as I can. And if you are new here and you've yet to subscribe, please hit the subscribe button, as that will ensure you don't miss any future videos. Until next time, take care.